Good afternoon and welcome to all to this webinar hosted by the Export Credit Guarantee Corporation ECGC and the Hindu. Today's theme is the importance of export credit insurance for MSME exporters in post-COVID trade. Our panelists today include Mr. M. Senthilnathan, Chairman cum Managing Director of ECGC and a career ECGC official who has served in varied roles at the organization before rising to the top. Dr. A. Shaktivel, currently in his second term as President of the Federation of Indian Export Organizations. A veteran of the exporters community, Dr. Shaktivel is also a former chairman of the Apparel Export Promotion Council. Our third panelist is Mr. Ramesh Raja, President of the Coffee Exporters Association and Chairman of Ramesh Exports Private Limited. A member of the Coffee Board, Mr. Raja is himself a coffee grower and plantation industry expert. And I am Suresh Seshadri, business editor at The Hindu and your moderator for this afternoon. Let me start by asking Mr. Senthilnathan to make a few opening remarks before we begin the discussions.
Good evening and thanks, Mr. Suresh and my fellow panelists. It's a nice opportunity to interact with you and the audience. As all of you may be aware, ECGC was formed by Government of India in 1957. To promote exports by providing export credit insurance services to exporters. Export credit insurance itself is a field which is a very latest development in the insurance sector itself. It has just 102 years of history of business. It started in the UK and slowly the concept picked up. The idea behind export credit insurance was to ensure that the industry in a particular nation is able to capture the world market, service the world market so that employment as well as economic benefit accrue to a nation. So as you can see from the normal concept of insurance for profit, this credit insurance, export credit insurance begins with the concept that the export needs to be promoted from the country so that employment and other related economic benefits can accrue to that country. This starts with some developmental objective. It is not a purely insurance as a business objective and a profit by doing an insurance business. It has a developmental mandate as the main objective, promotion of exports from the country. But having said that, over a period of time, governments all over the world has moved, even when you do a developmental role, promoting exports, it cannot be at any cost you have to promote exports. There has to be some cost benefit exercise. So this export credit insurers and export credit agencies should adhere to some market-based principles. What can be the market-based principles? At least the cost has to be recovered. Even if you don't need to have profit, but the cost has to be recovered. But in a developing economy like us, the government has, through various instruments and various memorandum of understanding, has made us to communicated to us that not only cost, you need to make some surplus. It is not that you make a profit like a commercial profit-oriented organization, but ensure that you have some surplus so that you don't run with the begging bowl to the government for each and every time there is a crisis in the global trade. So this is the development. All over the world, this development is progressing at this pace only because the world, many nations which are very strong players in exports like Germany, Canada, USA, and Spain, Italy, and other nations also have moved towards making the credit insurance a market-oriented, if not a profit-generating, at least a break-even basis export credit insurance is done all over the world. And when we started in 1957, we initially started with a cover for exporters, and then over a period of time, then within 3 to 4 years, even in those days, it was found that the small and medium enterprises find it difficult to get working capital loans from banks when it comes to export purposes, because typically export orders used to be larger than the domestic orders, and the capacity, the requirement for working capital loans used to be of much higher scale, and asset-based or this security-based banking was not helpful, because otherwise capable exporters may not have enough security to offer to the bank. So at the encouragement from the government, we designed an insurance scheme to the banks also, so that they can lend adequately to the Indian exporters who can complete the export orders and also repay the loan after completion of the export order. So these covers were given, and over a period of, in a matter of 5 to 6 years, the covers gained wide popularity, and many banks have started taking for all their exporter clients. So, so much so that currently 22 banks, all the government-owned banks and another 10 private banks have taken covers from us for their entire export credit portfolio. And 50% of export credit, working capital export credit disbursed in the country is covered under our cover. Apart from this, we have also helped the Indian exporters to overcome Asian, African financial exchange crisis, devaluation in 1970s and 1990s, when Iraq and the Iran war happened. Many failures have happened. We had paid claims. And now, latest was 2008-9 global financial meltdown, when the entire world went into almost a recession. It was export credit insurers like us who were willing to stick our neck out and then take a risk on a buyer in a foreign country for credit terms. In fact, we took so much risk that even when the economic papers were flashing that General Motors is proceeding, may likely to go for a liquidation or like this, 2 of our customers have taken cover from us before this development has happened. We continued our cover till the customers wanted it at the same level. We said, it is, we are with you. We will not withdraw our cover when the times go bad. We will continue our cover. We may not be able to give new covers to any other exporter, but we will continue covers. We are not going to be a fair weather friend. If the weather is changes, then I am withdrawing my cover. It's not going to be my motto. This happens even now in Russia. It has happened when the Russia-Ukraine war has this thing. There were around 30-40 exporters who have taken our cover. We have only informed them that please ensure that your bank is willing to handle the documents and they are willing to receive money from us. There is some way that they will receive money. Now, I understand that engineering goods exporters have started receiving money from European sources, euro through euro. Their bankers are handling, and our cover is continuing. And some of the exporters where we have, because of buyer risk, we have cancelled cover also. We have reinstated the cover after 2-3 days and informing them what precautions that they have to take. They have to ensure that they are not, their buyer's bank is not in that banks which have been removed from the SWIFT network and directly within that 7 banks identified by the US sanctions, so that this transaction doesn't come under the undue attention and the payments are prohibited from reaching India. We only ask, talk to your buyer, change the banker so that you can get your payments, and your Indian bank is willing to handle the payment from any other source like Dubai or from Europe, then it will be possible for you to, and our cover will continue. So this kind of help also we do. So much so that, see, in the last 5 years, our income in premium income was 5,000, slightly less than 5,900 crores. Our claim payment was 4,650 crores, and we have some more claims left to make payment. Our claim payment is 80% of our income. In the general insurance industry, anything above 60% is considered to be a claim, good claim track record, and which the payments that we have made itself supports our contention that we are with the exporters. Now, apart from this, in the last 10-12 years, what we have evolved is that we have also registered ourselves with IRDA. Though we are 100% government owned, established with a special mandate, we are willing to compete with the private credit insurers so that the exporters will get the opportunity of comparing our products and the cost charged by us and also what is offered by the private players. The exporters can choose what is best in their interest in terms of cost as well as in terms of cover. And we have also given many options to exporters. Earlier, we used to tell exporters that you have to cover all your turnover. Now we are willing to look at either one transaction or many transactions with one buyer, or some of your buyers, or all your buyers. But relatively the cost consideration will vary. So the option is available to exporters, whichever type of policy they want to take, and they can get our cover for exports made on credit terms. Now, what the organization customer profile looks at it, we have 16,000 exporters, of which around 14,000 exporters are medium and small enterprises. Medium and small enterprises, what we mean is exporters whose credit insurance requirement is less than 40 crore in a year, policy value 40 crore in a year, or exporters working capital loan requirement is less than up to 80 crore in a year. This in a way enables an exporter with 80 crore working capital loan with a 2 or 3 times export turnover to do an export business of around 250 crore and a policy cover of 40 crore, covering at least 3 to, depending upon the credit period, he can do a turnover of up to 250 crores in a year, remain as a medium and small enterprises exporter. Now, my general comment on the export transaction will be, unless you give credit, there will not be a global market, wide global market available to you. It is very difficult to export internationally without giving credit to the buyer. The competition is so much that the buyers will switch from one country to another country where they are able to get supplies on credit basis. So you have to give credit, but when you give credit, please remember that credit risk is intertwined in every transaction. So it is for you to recognize and then take adequate protection or risk management measures. There are various ways in which risk management can happen when it comes to credit risk. Maybe you can take a irrevocable letter of credit confirmed by a first-class bank in Europe or in India, where you are sure you are able to, but there also you run the risk of a LC opening bank going into certain problem, like what happened in the bank in case of Bank of Credit Commerce International, and during global financial meltdown, some of the banks have stopped paying for their LCs because they themselves have got into problem. But that itself, that is a slightly rare once you get an LC from a first-class bank. But the problem is this adds 4 to 6% cost to the transaction, because when you ask your buyer to open LC, and the LC has to be opened and the other bank has to confirm, or Indian bank has to handle. So many buyers are reluctant to open, and if they open, then they will reduce the cost that they are going to give it to you. So globally, international trade is moving towards open account trading, where once an exporter and buyer know about each other and their business transaction is in conformity with each other's requirement, buyers in many countries insist on sending the goods directly to them, and documents also many cases directly, and some cases they only ask the banks to do a collection service. So this avoids document handling charges of $400 at every desk for a single shipment document, which also obviates which also reduces the cost, but also increases the credit risk for the Indian exporters. We are covering open account transactions for many on many buyers for Indian exporters, which is the order of the day if you want to expand the international market. So with these words, I would like to close my comments here, and then we will take the things forward as we proceed further. So the final comment is, please expand your international business by giving credit. And when you give credit, please remember that there is credit risk insurance in every transaction that you do internationally. Take adequate protection.
Thank you, Mr. Senthilnathan. This is very informative and very interesting, and I'm sure a lot of the people in the audience are certainly very finding this interesting. Dr. Shaktivel, could you bring to bear some of the perspective that you have from the different hats you've worn in the export community?
Thank you, Mr. Sheshadri. See, the thing is, as an exporter, export credit insurance is a must, especially nowadays with the geopolitical situation and war against Ukraine and Russia. You name it, we have a lot of risk. So this credit insurance is a must, and actually ECG is the only one company is doing now, but there are government has allowed many companies to come forward. Even if they are 2021, they said that banks also can do this. but 85% of the business is covered by ECGC only. See here what happens, still we believe that exporters are not well informed about this ECGC portals. Now I really appreciate the Hindu for taking this course and conducting this webinar. Thank you, Hindu. The same way, I request Mr. Sedil that they should involve themselves with the association of all over India, especially MSME sector. They should to propagate that ECA, that is export credit insurance, is important, especially this present climate. What we learned from FIO is only 30% of the exporters are covering this year ECGC. So 70% of the exporters are still left out, thinking that yes, we have a good buyers and it's not necessary for us to cover. Why we should pay extra money? But my request to the exporters, please don't take it for granted. By experience for last 35 years, the biggest buyers of the world has failed in their payment. So nowadays we can't predict, yes, my buyer is safe, and we don't know how to do that. So my request to the exporters community that please take credit insurance, whether you have a business with them for 30 years or 3 years or 3 months, the first thing should be take insurance cover. When Sedila was talking about this ECGC cover, is the importance of ECGC, what are the services they do. Here as exporter, I want to make 2-3 requests to the Sediladan. That is, when the exporters apply for a credit insurance on a particular buyer, you fix a time limit with your office. That yes, within a week's time or maximum 10 days, because we can't wait for the 2 months or 3 months for the approval. So you should say that yes, within 10 days we'll give you the approval. Then only the exporters can go in for the signing a contract. Because if you take time, because export is tomorrow. So my request is it should be done on that way. On the same way, when exporters file for a claim, again, it should be time bound. Sometimes I have seen it's more than 6 months, 8 months it takes to pay the claim. So it should be done immediately. That only that working capital and other things will be helpful for the exporters. The third thing now, whole world is online business. Everything is online. So ECGC also should come online. When we file the claim online, it should be immediately responded by over the concerned officials. Yes, your claim has been registered. Your claim number is such, and we are working on this. By 10 days or 15 days, we will be entertaining your claim. So these are the points which Mr. Dilal should take care of it. Other than that, I'll come later. Thank you, Mr. Shashadri.
Thanks, Dr. Shaktivel. Very interesting points you've made. I'm sure Mr. Senthilnathan is sort of cognizant of these suggestions of yours, sir. Mr. Ramesh Raja, you come from a very interesting export sector, the plantation sector. Would you like to just give us brief opening remarks, sir, before we start our discussions?
Yeah, thank you, Suresh. I'd like to give a more of a commodity perspective. You know that in commodity, you look at the costing, it's basically 3 elements which form your costing. Number 1 is obviously raw material, and number 2 is capital. And then, of course, now the third, which is increasing in importance, is logistics. So capital is a very important part of your cost, particularly today with all costs increasing. Your raw material costs are going up, your logistics are going up. So capital becomes an important factor. So, availability of capital and protection of the capital becomes very important in today's market. Now, I'm more of a coffee person, so I just use that to illustrate the issues of the changes which have taken place in the market, which I think is applicable in all, because I noticed Mr. Senthilnathan also mentioned this. In coffee, basically, you can divide the market into 3 categories. Then a first category would be, Western Europe, North America, Far East. The second category would be Eastern Europe. And the third would be West Asia, North Africa. Now, the first category, that is Western Europe, etc., payments were always done on cash against documents through the bank on first presentation. We follow, there's a standardized contract, which is called the European Coffee Contract or the New York Green Coffee Association contract, which the one thing which is favorable to exporters is that the buyer must always pick up the documents and pay for them. So the risks were minimal, if not zero, because the documents were sent through the banks and you got paid immediately. So there was no real problem in that segment. The second two segments, Eastern Europe and VANA, we followed the LC route, confirmed LCs. So there also the risk looked minimal because you had confirmed LCs from Indian banks, and everything looked fine. But now, over the last few years, which got hastened by, I think, COVID. I would not say it was only COVID which caused it, but it started earlier and then now it has accelerated during the pandemic. That first, as Mr. Senthilnathan pointed out, people wanted to save the cost of the bank handling charges. They said, why don't you send the documents? I'm talking about the first category, Western Europe and North America, where they said, send the documents directly to us. So we save on bank handling charges. Now the problem, which again he has mentioned, is USANs. Every buyer now comes and says, I do not want to pay on first presentation. Give me 60 days. It started with 45 days. It's now gone to 90 days. And I think soon it should be 180 days. So even large buyers, some of the largest in the world, which are household names, are asking for 120 days credit. I mean, to me, it is not logical given that interest rates are lower in Europe and interest is high in India. It's not logical why I should give credit to a large company, coffee buyer but that is what is happening in today's market. And obviously, you can understand that in the other segments, now the first segment was where the payments are easy and assured. Now you're obviously taking much more risk with Eastern Europe and VANA. Now these segments, they are very reluctant to open LCs. And as pointed out, they were not confirmed by Indian banks. So recently you had this problem with the Russia-Ukraine thing, which again was mentioned earlier, that payments were not received. Though you had a letter of credit, payments were not received. And some payments have been received, but still, the case of soluble coffee, many payments have not been received. So the risks are increasing. But the problem, there's a little contradiction here, is that as you just pointed out, your risk is going up, but there is a cost to handling this risk. Now, if ECGC increases its premiums to make a profit, then your cost goes up because ECGC is adding on the cost to you. So what we would request ECGC is they should do a commodity-wise analysis because coffee generally, till date, the performance is very good. But we pay the same premium as high-risk industries. So I think today with all the data available with them, they should look towards coming with different risk rates or risk premiums for ECGC based on the individual factors, not just companies, but also on the commodities, past track records, rather than charge. See, most of us know in coffee, I know, they say, okay, go to the bank and say, I go with your whole turnover policy. I do not want to take individual policies. And here I agree with Dr. Saktivel that time is of essence. See, today, people call you on the phone and confirm the business, and confirmation is sent up WhatsApp, not even by email, and they expect you to ship immediately. So you don't have the time or the luxury of time to go and make an application to ECGC and says, please cover this particular shipment of mine. So I think two things we have to remember. One is, of course, risk is increasing, but at the same time is of essence. So I agree with both Dr. Saktivel and Mr. Senthilnathan that yes, risk is important, time is important, and I add a third point, cost is important. Thank you, Suresh.
Thank you, Mr. Raja. Really appreciate your comments. Very interesting and illuminating. Let me start by asking both Dr. Shaktivel and yourself, Mr. Raja. ECGC has this export factoring facility which has been targeted for the MSME sector. Now, based on your experiences, Mr. Shaktivel, Dr. Shaktivel, and Mr. Raja, how adequate or otherwise is this package of financial products, including working capital financing, credit risk protection, and collection of export receivables that ECGC currently offers? What more can be done to improve this facility? I mean, generally, the factoring facility. Would Dr. Shaktivel like to go first?
Yes, see, the factoring is now available not only by ECGC, but a lot of banks have also come in, a lot of international banks have come in, a lot of international agencies are there. As far as factoring cost is concerned, ECGC is higher and Indian banks are higher. So only the international agencies who is taking care of the factoring, because they have an arrangement with the foreign bank. So immediately when the bill is given, we get the payment. 90% we get it, the payment immediately. And also the cost is not very much. The spread is maybe 1% to 1.25%. But here it's not possible because the cost of fund in India is higher. So any bank wants to do the factoring, they're not able to give it in a cheaper way because their interest rate is higher. So we do it with the factoring, of course, with the foreign banks and foreign agencies. And another advantage, they have a tie-up with the buyers also. So if they want to do it here in the ECGC or some Indian bank, they should have a tie-up with the buyers. So the buyers should have that, suppose it's a State Bank of India, State Bank of India should have a tie-up with the buyers. So some understanding MOE should be there. Then it will be easy for the Indian bank or ECGC to do this factoring. That's my point.
But in terms of MSME sector, given the fact that MSMEs probably don't have the sort of, should I say, wherewithal or market expertise or international access to the international bank segment, wouldn't ECGC's factoring or domestic Indian other banks factoring be more crucial and critical for this smaller MSME exporters?
So the thing is, the MSME exporters now, we have our main aim is to educate the MSME exporters to the international level. We conduct classes, each local head office. Periodically, we conduct this regarding the export finance, regarding the factory, regarding the ECGC cover. We do that. So the exporters, again, whether MSME or large exporters, cost is important for them. ECGC cover factoring is high. Why MSME should go for the for this? Because again, the factoring thing is they go by the valuation of your company. So what is the rating you have? According to the rating, you get it. So for MSME exporters also doing factoring with the international companies or international banking is the cheaper.
Okay. Mr. Raja, would you have any comments on the factoring part of it?
Yes. See, now in coffee, there are two types of exporters, like in any other thing. The large companies tend to be multinationals. So they borrow at below sub 2% interest levels. So for them, factoring is not important because the transaction cost of factoring itself would be higher than that. So they prefer not to do factoring because it's easier for them just to borrow outside of India, which is what the multinationals do. Now, when it comes to the MSME exporters, they find that the banks do not encourage factoring for the simple reason that when they give you packing credit prior to shipment, the banks insist that the documents should be settled only through them. So they do not let you go outside to anybody else. So the banks insist that the documents, because they have financed you for packing credit, they say the bills must be given to them and they will handle it. So you really do not have much option. So while all these things exist, we find that in reality, very few MSME have access to these facilities. It's more available to larger trade houses or to larger industry than to the small exporters. We have had a discussion on factoring a few months ago during our association meeting. And most of the small and medium exporters were very clear that their hands are tied by their banks. So when the bank does not allow you to go outside of their financing, where do you have the option? You're forced to borrow from the bank give your bills to the bank and pay the interest rate and the charges of the bank. It does not matter whether it's a government bank or a private bank. They all operate on the same level.
Interesting. Mr. Senthilnathan, would you like to bring in your perspective on how successful factoring has been for you all? Because part of your mandate has also been to promote the MSME sector, and factoring and so on was designed as products to help them. So how successful have you been on this objective, sir? Sir, I think you're muted, sir. You have to.
Thank you very much for this offer. Factoring is globally is gaining importance only in developed economies, and where the developing economies or this WANA or this East European or African market, because you need a proper credit information system and proper action system, and you will also need a buyer to come on board with you to agree that it is going to be a tripartite agreement: exporter, buyer, and the factoring company. Because all the bills the exporter is going to raise on the buyer will have to be routed through this factoring company only. So it is a total arrangement for one full year. Then it can be renewed for every year. So the buyer also has to be on board. So there are some challenges, some of the market. But in markets where this factoring is very well recognized, especially in Europe as well as in China and some other countries, US also, factoring is gaining very much popularity, and many MSMEs are using it. But in India, traditionally, what happens, the banks are an effective competitor. Maybe as Mr. Ramesh said that they have to give the bills to the banks. Not only that, in India, the factoring, when the export bills are factored, you don't get the interest subvention from the government. So that the interest has to be charged by the factoring companies based on the credit period that is built into the export bills. So the financing is made available once the bills are submitted. 90% finance is given and the 10% balance is given on the due date. So suppose the collection is going to take 90 days or 120 days time, that interest cost is built on that, and the collection charges and the document handling charges. And other than ECGC, there are very few factors in India who can do non-recourse factoring. Suppose the buyer becomes insolvent or before payment, or he becomes a financial defaulter, the other factors will go back to the exporter so that they can pay it back. Whereas the ECGC will not go back, we will have to proceed legally against the buyer. So there is a credit protection charges also available. So this makes the arrangement slightly costlier. But we are trying various other methods how we can reduce the cost for the Indian exporter. We are applying to RBI so that they can give us authorization to deal in foreign currency, and we will provide funds in foreign currency and do the factoring in the currency in which the bills are drawn, so that we can also charge interest as applicable in the Western markets plus some margin to it. Because we are not going to borrow and then do the factoring. We will set aside funds and then do the factoring and try to earn on that. That is how we are planning. And maybe that once the permission is given for ECGC to be an authorized dealer of class 3 who can factor the bills on foreign currency, maybe we will find more takers. But right now we have around 3-4 experts who are doing factoring business with us. And interestingly, we have taken risk on some of the Kenyan buyers also, and we have been successful. So far, we have done 50 bills and we have collected all the 50 bills also. So the difference between other factors is we are willing to take risk on some of the emerging markets also.
Sure.
And like in credit insurance cover, we take risk on most of the countries in the world, where other private players may not take, but we are willing to take it.
And you said your application with the RBI is pending, or you are going to make an application?
Yeah. That process is, we have initiated, but it will take some time for us, and we have tied up with IDBI Bank and other bank so that application, once it is there, we convert our rupee funds into dollar funds and then make the foreign currency factoring applicable available to exporters. Here, I would like to quickly respond to comments of our distinguished panelists, Mr. Saktivel and Mr. Ramesh. See, we have not increased the cost of credit insurance in the last 15 years. In fact, we have underwent 3 downward revisions in the credit insurance cost. Even the last 2 years when pandemic made global risk, buyer risk go up, we have met claims, we have not increased the cost. The only area where we are thinking of increasing the cost is there are some choices available to exporters where they can cover single transaction. There are the policy products which covers your entire exports done on credit basis. I get a spread of risk. But there are exporters who come to me for covering one transaction with one particular buyer. Obviously, it is an adverse selection. And the last 10 years, our loss ratios are beyond 175%. So it has become unsustainable. So we will increase the cost there only. But in any case, that is limited to 2 to 3% of my business. All other products, we are going to continue with the existing cost. And wherever possible, we'll definitely give further discount. Global average of credit insurance cost for ECGCC last year, we covered 2,70,000 crores worth of exports done by exporters under the credit insurance policy that we have issued to them. The average cost is 18 paise per 100 rupees, slightly less than 18 paise per 100 rupees credit transaction. And our claim payments is now close to 75% of the business that we do. And the balance 20% is built as a corpus so that in some times of calamity, our claim payment can exceed even 100 or it can go up to 200, like what happened in the global financial meltdown period. For 2 years, we have been paying claims more than 100%. So that is how the insurers operate. We are not looking at profit and we are not looking at profit-oriented pricing of the product. We are looking at pricing in a way that we are able to keep our heads above the water. That is the only thing that we are working on the mandate. That's why we are able to risk in, apart from Western Europe, we take risk in Ghana, Eastern Europe, we take risk in most of the African countries, and we take risk in most of the Latin American countries. In fact, African countries, we have also rated them better so that our premium rate can be lesser for the export.
Sure.
And Mr. Saktivel's comment, yes, we are moving towards a quick information. But sir, when it comes to credit information, if the buyer is new to both, even to ECGC as well as to exporters, and the credit requirement is very huge, we need to depend upon information report on the buyer. If the information report is available, then we will be able to give limit in 10 to 15 days time. Sometimes international agencies take 6 to 8 weeks to write an report, credit information report on the buyer. So that takes time. That is actually beyond our control. But what we can do is like coffee exporters. Suppose they have got a global base of buyer. They can give it to us. We can take report and analyze the buyer and keep it in our system. Whenever some exporter approaches us on those buyers, I will be able to give a limit immediately without any cost to them. If they give the buyer list only, I will spend money on taking the report on the buyer, assess the buyer and keep this thing. That is one solution. Or if there is some indication of, in fact, we have tied up with around 20 agencies globally, and we also paid a premium fees so that we can tap their information resources. So that if the buyer is already an established buyer, I think many of these soluble coffee or instant coffee buyers will be branded and very established names. The information report will be available on them at the touch of button where we will be able to provide credit limit very quickly. But the problem is more envisaged in the ready-made garments, engineering goods, agricultural products, so where they find buyers who are also small or medium enterprises who are also establishing there, and their information is still yet to be made available to the outside world. So there we find it difficult. We are trying to improve our system, and we have recently launched mobile apps so that exporters can raise their queries, see our product. And we are moving towards an online, but right now it is not ready. Maybe another 6 months to 1 year time, we will be in a position to accept online application from the exporters. Yeah.
Thank you, Mr. Nilan. It's very interesting you make this point about information asymmetry, or rather the lack of information, which proves to be a bit of a stumbling block. Dr. Shaktivel, very quickly, since we sort of beginning to sort of get closer to a timeline where we want to throw it open to the audience questions. From your perch at FIO and also as a former Apparel Export Promotion Council person, how can existing credit insurance products for exporters, especially for MSMEs, be fine-tuned to enhance the competitiveness of these small exporters in this challenging environment? We know that currently post-COVID and also in the context of this conflict, logistics issues have sort of mushroomed all across. Supply chains are disrupted. There are shipping issues and so on. So from your perch, Dr. Shaktivel, what do you think can be done to fine-tune competitiveness, enhance competitiveness when it comes to fine-tuning the credit insurance products?
See, actually, in every segment, if you see that even the banks, the other thing, there is a separate package for the MSME, MSME exporters. The same way, ECGC should also have a package for the it's not MSME means not that the person who does 500 crores or 1,000 crores, even the MSME, now there is no limit of turnover for MSME sector. MSME sector does that much. But at least you say the limit is, package credit limit is 50 crores, and they do about 200 crores or 150 crores. So you have draw a line for the MSME package, and you introduce a special package for the MSME in the ECGs. Now uniform, the rate for whether MSME or large exporters or a small exporter, all same. Now they should try and do this, some product for a MSME. ECC should come out, say that this product is exclusively for MSME, and you put the qualification, whatever the qualification you want to put it, you put it. That will help the MSME exporters to come in for more coverage. What happens to the MSME exporters when they see that cost, because nowadays the whether apparel or any other thing, we do with a thin margin. Our margin is maximum 3 to 5%. So there, every MSME exporter sees that our cost is increasing because of the ECGC. Then another issue is ECGC never cover LC bills. See, the thing is, for exporter, whether it's a ECGC, whether it's a DA basis or a LC basis, the risk is the same. When there is a war, whether LC bills are not paid, when there is any disturbance in the country, even the DA bills are not paid. So my request for a long time with the ECGC is there should be some cover for the LC bills also. That will, especially for the MSME sector. So that will give a lot of protection for the MSME sector.
Thanks, Dr. Shekhed. Mr. Ramesh Raja, when it comes to the plantation industry, even before COVID, there was already a struggle with the increased competitive intensity in the export products, including coffee and tea, even before COVID. How has COVID impacted the plantation industry and coffee particularly? And what is the way forward to enhance competitiveness, particularly in terms of credit availability, credit insurance, and so on?
Yes, the problem in commodities is that there is generally a surplus. Okay, now there's a temporarily, it's cyclical, but right at the moment there is shortages. But so when you have surpluses and you're competing against, say, Latin America, Africa is a little easier. But when you're competing with Latin America, for example, where the logistics are much better, they are able to move cargo much faster, which means that the working capital blocked is much less. So in India, the problem is that our working capital rates are high despite interest subvention, and two, our logistics are poor. So when we add on insurance, most of us have stopped offering coffee or anything on a CIF basis. Earlier, it used to be CIF. Now it's mostly become C and F because the insurance premiums are high in India. I agree with Dr. Senthilnathan that ECGC has really made a lot of effort. But despite that, I'm talking at the global level where you're competing with others. Whether Latin American countries are subsidizing or not, I do not know. It's something for WTO. But the result we are finding is that when I'm offering a CIF rate, I'm going to be higher priced than my competitor from Latin America. Now, basically, we look at the North American market. India has lost that market. 30 years ago or 40 years ago, India was a large player in the North American market. Today, we are almost non-existent in the North American market because our prices have become not competitive, whether it is because of freight, whether it's because of insurance. There are so many factors which have made our plantation crops not viable in the North American market. So now we are depending on, you can call it West Asia or Middle East, the Arabian Gulf countries, we're dependent on Western Europe. Even Eastern Europe is a struggle because of credit risk. So Eastern Europe, the problem is credit risk. So with that, ECGC can play a major role. But like I said, the problem is in coffee generally, we look at the claims. If ECGC were to do an analysis industry-wise on the claims that they have paid, they'd find that on coffee it is minuscule. But you pay the same premium as some other segment where the claims are higher. I understand the concept of insurance is spreading the risk and cross-subsidization. But when you're the one who's paying a higher premium, you feel that is unfair to me. My industry's performance is good. So why should I pay such a large premium? That's why I said that there's a need for ECGC to do an industry-wise analysis and arrive at, I agree with Dr. Saktivel that MSME should be given a helping hand, particularly, but also I think industry-wise segmentation of risk, apart from just country-wise, right now ECGC's premiums are based on destination. I think you should also now go to the next step and fine-tune it to industry-wise risk, so that an industry, plantation industry, which is generally low, a better performance on payments, should not have to pay the same high premium as a high-risk commodity. I do not want to name various commodity, but generally, so I feel that, it is something that needs to be done to make us competitive going forward. See, because we are going to be in the surplus next year, we are going to be in a surplus in coffee. We were in a shortage 2 years ago. We have small players. We cannot compete against Brazil on cost. They're much more cost effective than us. So every penny counts. And like Dr. Saktivel said, our margins are paper thin. 3%, I would be happy to get that. So, it's I think it's the cost efficiency which matters finally. It's going to be down the line, the future is cost efficiency.
Sure. Mr. Sendilan, would you like to respond to the comments Dr. Saktivel and Mr. Raja have made? If you do, then please respond immediately, after which we'll open it up to audience.
Yeah, I would like to only submit that the cost for credit insurance depend on the country of destination, because the political risk is attached to it, and commercial risk depends on the credit period. So far, we never looked at the commodity or item of export, because the credit period is the one that determines. Maybe taking cue from Mr. Ramesh Raja, we will take a study, and then we will also need to study the buyer's rating also. If the buyer is very good, it doesn't matter whether he takes coffee or he takes your ready-made garments or he takes engineering goods, then he will definitely, the payment risk is less. But if the buyer is bad, irrespective of the commodity, then you are taking a high risk. So we will try to do whatever analysis possible, whether we can give a further fine-tuning of the premium rate. But this point is well taken. We will move towards such a fine-tuned premium rate. But this thing will be, when it comes to MSME, then it becomes another problem, because the basket you are going to offer to me in business is very limited. So if I do a individual company specific analysis, then I need a certain size of business. That is where we consider that. Let us see how much we can bring to the table with off-the-shelf product for an MSME with attractive premium rates designed to particular industry or designed for a particular market.
Sure. Thank you very much.
My request to Mr. Sendila then is, see, every financial institution has got a product for MSME. And if you take 70% of our export is by the MSME. So you should talk to the government, maybe MSME ministry or to the commerce ministry. See that there should be some product for MSME in ECGC. That's a must now, because so far it's okay. But now the risk is increasing day by day. The MSME exporters should be protected. That's my request, Mr. Dilawar. You should take it up with the MSME ministry and as well as with the commerce ministry, that there should be a product. Maybe you can get the support from MSME or MSME ministry or from a commerce. And also you can get some kind of a backup for the money also from RBI you can request. So we want to introduce a MSME product. So what is the best way to do that? So this we did it, Mr. Sendila.
Yeah, we are already talking to MSME ministry, sir. We are expecting certain good news in the next 2 months. We will be able to come out with a package for MSME.
Sure. Thank you very much to all three of you. We'll now open the floor to questions from the audience. I request everyone in the audience to type out their questions in the the panel there and put it out, and we will immediately look at the questions and ask the panelists. We already have a couple of questions, one of which is probably broadly covered. An attendee asks, I would like to know what is the exact role of ECGC in exports. Is it giving a cover for credits for the buyers in the international market? I think by now all of our panelists have answered that adequately, sir. Then Mr. Subramaniam asks, kindly give a solution for ECGC coverage for air shipment. I'm assuming he wants a very particular product for air shipment. I'm not quite sure exactly what he wants, but is there some way you can answer it, Mr. Senthilal?
Yeah, if I understand that they want the cover for air shipments,
Yes.
shipments made by air.
Yeah.
Shipments made by air is more like an open account transaction, because air shipments, even if you get airway bill, the buyer need not have to wait for airway bill. It is like more like if it is consigned, it is in his name. He will have to prove that he is that company, then he will take delivery, because air cargoes are delivered faster. And they don't have to produce the airway bill at the other end. They will have to tell the proof that they are the consignment is to them. Unlike your bill of lading, this thing. So this is like a more like a open account transaction. We do cover for many exporters. The only request will be to whether the Indian exporter is authorized to send such a transaction directly to them, open account. Because in terms of the regulations applicable in our country, the Indian exporter should have a star rating, that is, he should have been established exporter with a minimum 1-star export house status to or 1-star, 2-star, the exporter can check. And if he is authorized to send shipment directly as well as document, we will be willing to cover. We are covering for many exporters. There is no, because the risk is equal, whether you send it on a ship and then give a 90 days credit, or you send it by air. The exporter buyer has taken delivery of the goods, then the credit risk starts, and that point of time it is equal risk.
Sure. We also have a question now from a participant, Mr. Ramesh Vishweshwaran. He asks, when will ECGC cover raw materials, WIP, I mean work in progress, and finished goods?
It is, if the order that has been placed with you is specific to the buyer and you are going to manufacture only for the buyer, in case the buyer becomes insolvent and you will not be able to do anything with the goods work in progress, I think most probably raw material you should be in a position to use it to some other thing, or if the raw material also you are going to throw away, it is not going to be useful to them, then you can request a pre-shipment risk cover. We have designed the product that certain approvals are pending. Once we get it, maybe in another 2 months, we should be in a position to introduce. But the only condition will be that your product should be specific to that particular buyer. It should not be like something which can be used by some other buyer. Then we will request you to do loss salvage operations. Those things will come in play. Pre-shipment risk cover is specific to only products which are maybe copyrighted version you are manufacturing. If he is not in a position to take, you also cannot sell it. Those things we can cover.
Sure. Another question from one Mr. Chinnaswamy. We are having reverse factoring facility for one of our major buyers, and the time taken by the factor to discount the bill from date of shipment is around 20 to 25 days. Can we get cover for this period from ECGC?
Yeah, we can design a cover for them. So it can be a tailor-made cover that they want only cover for 25 days. Once their factor does the factoring, then my risk is over. So then we'll have to have a specific tailor-made cover for them. I would request them to write to our office. We will definitely be able to handle this, depending on the volume. We are looking at such covers also. We will definitely be able to.
Sure. Another participant, Mr. Anil Kumar, asks, are you using blockchain technology for having online transaction?
No. Right now, we are working with the CDAC so that our software can be revised and made web-enabled. So with a lot of security features, maybe at the time we look at it. Blockchain is not there.
Okay. At one LC can avail into different shipment. I don't understand the question. Can one LC? Okay, let me go to another question. Mr. Balasubramaniam asks, if shipment to Russia, Ukraine, did ECGC will cover insurance in current situation? If not, how can we get payment against that shipment? I think this is a question which everyone will be interested in.
See, unfortunately, what happens, the basic insurance principle is that when you take cover when the things are good, so that when things are bad, you get protected. ECGC, we do cover our existing exporter, even if they want to export now also to Russia and now also to Ukraine. But now if somebody comes and asks me a cover, it is very difficult for us to institute a new cover. So we will have to take so many other factors into account. Maybe we'll take a call on that. Now that there is some route of payment is available for Russian exports made to Russia, we will try to work it out. But otherwise, I will advise the exporters. See, I am not advocating you have to take credit insurance cover only from ECGC, but ensure that you have some insurance cover even when the times are good. We are willing to look at your requirements, and we are willing to design separate policy for you and maybe give you a cost-effective solution, but have some solution when the times are good, so that when the times become bad, your cover can be continued, business can continue. Like the global pandemic, what happened? Irrespective of every country, there is a lockdown, there is this thing, and there are many exporters. Buyer is also not at fault, exporter is also not at fault, but payment has not come because neither the buyer is able to clear the goods in his country or the goods were this thing. So it is a loss for both of them. We have paid claims.
Sure. There's another question from one Mr. Natraj.
As an exception, we have paid claims. So it is better to have a cover in good times.
Yeah, fair enough point. I mean, you can't just expect that once something goes wrong.
Once the house is on fire, don't expect insurance to give you fire insurance.
It's true. Mr. Natraj Kumar asks, I'd like to know the premium rate, maybe with an imaginary consignment cost and place and product. I think you did sort of refer to it when you spoke about 18 paise per rupees.
No, that is an average premium rate. So that's a global average. It is not specific to the policy, and specific to policy, I'm sorry,
it's very hard to
I am not in a position to answer right now. You can get in touch with any of our nearest branch from whichever town. If it is Tirupur, they are in Kumaran Road. If it is in Chennai, they are in Overseas Towers. Or if it is online, you just log into our website www.ecgc.in. You have a mail ID. Send a mail. We will send our premium rates by mail to you.
There's another question from Mr. Nikhil Gorfad, which says, new exporter, what help can ECGC give with the Indian embassy? I'm not quite sure. Do you all collaborate, or should I say work with the embassies overseas to sort of also assist in?
No. What happens is when a buyer in a foreign country does not pay to Indian exporter and he has covered with me, when he lodges a claim with me or report or default with me, we also alert the Indian embassy there, just whether it is possible to check with the buyer why he has not paid, whether any payment plan is there, whether something can be done about it. And some cases where it is not in ECGC's purview to cover, or we are not able to pay claim, also we do write to Indian embassies. Many cases they do intervene and they come back with the sometimes solution. Buyers are able to pay, and buyers are able to come out with a concrete problem why they are not in a position to pay. And so that helps us to set the record straight. If the exporter is not at fault, I am able to pay claim. But even generally also, the exporters can tap the help of, whether they are with ECGC, without ECGC, they can take the help of Indian embassy abroad for problems with the buyers. Not for prospecting the business. For prospecting the business, I will suggest them to look at the FIO and other promotion council's website. Buyer seller meet, they also organize exhibitions, try to participate and meet the buyer person and all those things. But in case of default or some problem, they can always write to the commercial attaché of Indian embassy in that particular.
There's a question from one Mr. Sandeep, and he asks, what is the procedure and documents required to buy ECGC policy for a single shipment?
Yeah, there's a proposal form that you need to submit that will ask for the details about the buyer to whom you are going to make, and what is the terms of payment as per your contract, and when you are likely to make shipment. And then if you make the proposal form, we will be in a position to see whether we can give cover on the buyer. Once we are willing to give cover, we will also, even before that, we can indicate you what is the premium rate. And once you are okay with the premium rate and we are okay with the risk taking on the buyer, once you pay the premium, we will give you the cover, and you can, once you send the shipment, give us information that you have sent the shipment, then the premium will become our income, then the risk cover will be started. So please approach the nearest ECGC branch or send us a mail, we will correspond with you.
Sure. Somebody called Jyoti is asking, in Kolkata, is there an office? I'm assuming there would be an office in Kolkata.
Yes, sir. Yes, sir. Kolkata, we have a regional office as well as branch office. There is some building called AC Market Complex. the exact address I don't remember, but it is there in our website.
Yeah.
All the branch office address is there in our website. Please check in our website.
Mr. Franklin Johnson asks, if we become an ECGC member, what are the advantages? Do you have a membership facility for exporters?
No. Actually, if you are exporting on credit, make credit insurance product. Based on there is nothing called a membership. Like unlike a export promotion council, we don't have the buyer seller meet or the exhibitions and all those things. Those things are not. The only benefit to take our policy is that credit insurance we can give you. The second thing that we can do is, suppose you get an order from a buyer. When you apply for a credit limit on the buyer, suppose we find the buyer has already defaulted to many other exporters here, or the buyer's status is not good, financials is not good, we can tell you that this buyer's financial position is not good, please don't do export on credit basis. Or we can sometimes tell you, don't do export, our cover may not be available. So that is a cue for you to take. And if the buyer still insists on export from you, you can demand very well advance payment.
Sure, fair. Then finally, I think we have time for one last question, sir. Mr. Bhaskar says, hi, sir, we are looking for export factoring. Is the ECGC having export factoring, as it's very important for the small scale companies like ours? I think we've already answered it largely because we have mentioned that you all have export factoring. So I think we're good on that. At this point, I would like to, we've reached the 5 o'clock time limit. I would like to thank Mr. Ramesh Raja, Dr. Shakti Vail, and yourself, Nathan, for sparing us time and illuminating us on this very interesting subject of how export credit guarantee and export credit insurance is critical for improving export competitiveness, safeguarding your interests, especially if you're a smaller exporter and so on. Thank you very much to all three of you.
We also thank Hindu for organizing this wonderful webinar. It's really useful, and I really appreciate the initiative of the Hindu trying to help the MSME sector, especially exporters. So it's a good initiative. I really appreciate the Hindu for it.
Yeah,
Thank you. Appreciation from my side also. And thanks to my fellow panelists as well as Hindu for the excellent initiative. And thanks for all the inputs. Then we will try to come out and try to exceed your expectation. Thanks for all the interest in ECGC.
Thank you.
Thank you.
Thank you.
Thank you also on my behalf to my fellow panelists as well as to Hindu for the efforts taken to put up this great show. Thank you.
Thank you very much.